Hey, everybody, welcome back for yet another edition of Kelly's Take Two Pre-Licensing Zoom Review, Math Edition. All right, who doesn't feel like doing some math on a beautiful day? Come on now, let's go. Now listen, if you are here for a little math review, chances are you may have a little bit of math anxiety. And guess what? You're in good company. I do too. In fact, there's a really good chance that I have something called, how did they say it? Dyscalculia, maybe. It's like the sister to dyslexia, except for math. Who knew there was such a thing? I know. So all that to say, you can breathe through it. You're going to get there. You're going to know enough so that you can pass the test the first time. If I could pass the first time with my math challenges, you can pass math, or you can pass the test the first time as well. We got you. So I'm going to go through every step. There will be no shortcuts. Every little step. If you develop shortcuts on your own down the road, fantastic. Otherwise, let's dive in. Now, what I'm going to be using is the math review that's located in your Google folder. So go ahead and grab that. And I'll grab mine as well, share my screen with you. The nice thing about the math review that's in your Google folder is there an answer key is in that same folder as well. But sometimes if you're like me, it just helps to watch somebody kind of go through and work the problems, and you can stop and start at your leisure. Think of this as your own personal Khan Academy, shall we say. Who does not love Khan Academy? Oh, love Khan Academy. Okay. So let's dive in. Let me make some room here so that what I hope is that you'll just see one problem on your screen at a time. Ooh, gotta get warmed up, don't we? Okay, all right, get in the zone, the math zone. All right, here we go. So some people will tell you, and I think it's a great idea, especially when it comes to word problems, to go ahead and try to go ahead and find the question, what is being asked of you, and then dive back into the whole entire word problem, just in case there might be some distractors or some such thing. If you know your formulas, then you will know what numbers to plug in and what you might need to avoid or ignore. All right, so this is telling us, if we look at the question mark and go backwards, it's saying, here's the root of the question, what is the amount of interim interest that the borrower had to pay at settlement? So we know that this is going to be an interim interest problem. When it comes to interim interest, that's going to be a proration. It's going to be a monthly proration for the month of closing. Interim interest is money that the borrower owes the bank on interest that falls outside of the normal billing cycle. So as with any proration, we're going to need to calculate the number of days owed. Let's go and write that down. So when it comes to a proration, pardon my messy handwriting on this little wonky board, proration problems, you've got to calculate, and this is shorthand, days owed. Whoa, that's interesting. Then you have to calculate a rate. And in this instance, it's going to be daily. And then you multiply. Okay. Now, when it comes to interim interest and it comes to calculating the days owed, the bank will make the borrower pay for the day the borrower moves into the house. So they have to, the buyer has to pay for the day of closing. So an interim interest problem, when calculating days, you always have to add one day. So let's go ahead and get ourselves set up for success. So this is going to be a monthly proration. So I'm going to write a 1 and a 30. In real estate school, we use a 30-day month and a 360 calendar day year, just so you know, unless the word problem says otherwise. All right, so we are, let's read the problem. a loan in the amount of that much, $316,500 at 4.5% for 30 years, closed on February 21st. Okay, so we know our month, and I just write it there so I don't accidentally do an annual proration. They're going to close on, I don't know why that's doing that. Let me fix it. They're going to close on the 21st. Let's try that again. Okay. So the buyer owes the bank for this much time plus closing day. All right, let's keep going. Let's read the problem. The first monthly payment is due on April 1st. That's so cool. I love that. All right, using a 30-day month and a 360-day year, what is the amount of interim interest that the borrower had to pay at settlement? All right, so let's do step one, which is calculating how many days does the borrower owe the bank. Now you could count it up on your fingers and then add one, or you could calculate it this way: 30 days in the month minus the close. Acting up. This little system is acting up, y'all. Okay, let's fix it. There we go. 30 minus 21, the day of closing, plus 1. Now, you might think to yourself, surely she can do that in her head. Well, I could, but why take a chance? So 30, type it into my calculator, minus the closing day, 21, equals 9, but the bank will make the borrower pay the day of closing. So I've got to plus 1. Okay, that is hilarious. It's 10 days. I'm sure y'all did that in your head. But again, I'm just showing you every step. So the borrower owes 10 days. So we did that, check. Now we have to calculate a daily rate. Here is your rate formula for interim interest. The formula is the loan amount multiplied by the interest rate divided by 360. And that will get us our daily rate. All right, so if we were to plug and play, we'd say, okay, so the loan amount is $316,500. The interest rate is 4.5%. When we multiply, that's going to get us an annual number, which is interesting, but you don't need it. And you just go ahead and divide by 360 to get you your daily rate. All right, so we're going to use this number and this number. We don't need that. And we really don't need all this information either. That's just extra. All right, let's go. So 316,500 multiplied by 4.5% key. Did you do it? You doing it with me? I got $14,242 and some change. But again, that's the annual interest this person will pay on the loan. So let's divide it by 360. And I'm going to put all my decimals out there. So the daily rate is $39. And then I'm going to show you, I'm going to put all my decimals out there. 5625, 5625. I'm going to take that. And so we did that. And this part says we're going to multiply. Multiply by the days owed. Multiply by 10. Okay. So it looks like the borrower is going to owe the bank an interim interest, $395, and we'll round up to the penny, 63 cents. Very good. Now again, you can watch that over and over again for muscle memory. You can pause as needed, but we're going to clear the board and move on to the next problem. All right, team, let's go ahead and hit number 2. Let me go ahead and make some room so that you will be able just to focus on number 2. Excuse my scrolling. All right, here we go. Now, again, let's follow the advice of other real estate instructors and go ahead and find the question and then dive into the main body of the question, of the word problem. So let me get my little pen ready and we'll be off to the races. All right, let's look for the question mark. There it is. Let's look for the question word. That's how. How much will the monthly PI payment be using a factor of 5.07? Oh, so fun. Okay, so this is a monthly mortgage principal and interest question. So let's go ahead and off to the side, let's write the formula for principal and interest. Let me get in the zone. So the formula for PI is the loan amount divided by 1,000 because the loan factor chart is based on a $1,000 loan, multiplied by the loan factor. Okay, and that will be your PI. So let's go. A buyer is under contract to purchase a home for $380,000. We need that number, and is qualified for a 90% LTV mortgage loan. How much will the monthly PI payment be using a factor of 5.07? Uh-oh, we have a twofer, don't we? So we don't know what the loan amount is yet. We have to figure that out. We have to figure that out by solving for the loan amount. So we've got to do a LTV calculation. Here is your memory circle for a LTV calculation. So here's where your LTV is going to live. It's a percent of what? Of the price of the home. Now remember, if you're given two prices, one is the appraised value and one is the sold contract price, you use the appraised value, right? And then here is where the loan will live. So that's what we're solving for. So this individual has a sale price of a home of $380,000. They're getting a 90% LTV. If two numbers are in the bottom, you multiply and that will give us our loan amount. So let's go. Grab your calculator and do use a calculator, not your cell phone. Your cell phone will mess you up. Okay, trust me. 380,000 multiplied by 90% key and stop. So the loan will be $342,000. All right, now we can plug and play with our monthly payment formula. So the monthly payment formula over here says plug in the loan amount, which is, sorry, I don't know why it's doing that. Give me a sec. Let's make that tidier. Okay, a little bit neater there. All right. So the loan amount is $342,000. We'll divide by 1,000 and we'll multiply by that loan factor of 5.07, and that will tell us the monthly mortgage payment. So you probably already have $342,000 in your calculator. So go ahead and click divide, click 1,000, 1,000, click multiply, click 5.07, and I got $1,733.94. And that will be their monthly principal and interest payment for the whole time they are owning this home, for whatever, however many years it is. That's probably a 30-year loan. So that number will stay the same over the life of the loan. Just more of it, that each monthly payment, more of it's going to go toward paying off the interest first. And then about midway through the term, it'll flip, and the majority of the payment, monthly payment, will go towards paying down the original loan amount. Fantastic. Let's clear the board and go on to the next one, number 3. Okay, I just have to press a few buttons here. Let's go ahead and get number 3 up here. Okay. let's follow suit once again. Let me get my little magic marker going here. Clear my calculator. And let's find the question and then dive into the word problem itself. So who, what, when, where, and how. So here's our how and here's our question mark. So let's read the question. How much will the buyer owe for a 1% origination fee and 2 discount points associated with this loan? Okay, so this one is about lender fees. And it's telling us they're going to get a 1% origination fee and 2 discount points. Well, paying that from the borrower's point of view, I'll use those 2 words interchangeably. Points for test purposes, 1 point will cost 1% of the loan amount when it comes to discount points. So 1 point costs the borrower 1% of the loan amount. All right, so we need to know the loan amount. That we need to have. So let's see if it's going to tell us, or do we need to solve for the loan amount again? We're going to hope not. A buyer is under contract to purchase a home for $250,000 and qualifies for an 85% LTV loan at an interest rate of 5%. How much will the buyer owe for 1% origination fee and 2 discount points? Oh man, we got to solve for LTV again. So let's go ahead and do that. We'll do that here. Oh, right. What do we know? This borrower, the bank will lend them 85% of the contract price or appraised value, whichever is less. And it tells us they're going to get a home that costs $250,000. All right. So how much will their loan be? Let's check it out. 250,000 multiplied by 85% key. Their loan should be $212,500. Okay, so we got that. Now we've got to do the fees. We have a 1% origination fee, and we're going to get 2 discount points. Remember, each discount point costs 1% of the loan amount. So 2 discount points will cost 2% of the loan amount for a total of 3% owed in fees. All right, and the way that we pay for those is based on the loan amount. So your problem will look like this. $212,500 is the loan amount multiplied by 3%. So let's find out, how much will this borrower owe the bank in fees? Did you get your answer? Okay, I got $6,375. Fantastic. That's just not just a tiny bit, is it? All right, let's move on. I'm going to clear the board and we'll go do number 4. Okay. Again, let's go ahead and find the actual question and get ourselves set up for success. So find the root of the question: who, what, when, where, and how. So here's the word what, and here's our question mark. So let's read it. What will the tax proration be on the closing disclosure for a closing on October 13th if the buyer owns the day of closing? You might freak out about that, okay? Because we don't really teach it that way all the time in class, but I've taken a few of those PSI practice exams, and oftentimes they'll say in the question, the buyer owes the day of closing. So I figure I might as well get you ready for that type of a situation. Okay, so that means we're going to do what? Chances are we're going to add a day. but let's work through it. So how do we do a tax proration problem? We do that just like any other proration problem. We have to calculate the days, number one, calculate a rate, number two, number three, multiply. There actually is a fourth one for this in terms of who's going to get a credit and who's going to get a debit. So let's go ahead and knock that out first. So let's write over here, debit. That means someone's going to pay money or be charged money. And let's do a credit. That means somebody gets money at closing. All right, let's think this through. We've got property tax bill. It has been paid already by the seller. So the seller paid that bad boy in full. So what is the seller going to want? The seller wants to be reimbursed. So who's going to reimburse the seller? The buyer is going to reimburse the seller. So we're going to have to charge the buyer money for the time the buyer is moving in the house. That means we're going to debit the buyer and credit the seller. Okay. That alone is really important to lock down because sometimes you can solve these proration problems and not even do the math for real. You can just logic your way through it. But I'll show you the steps now just for fun. All right, so what do we need to do? We need to calculate days owed. So I'm going to draw myself a timeline. This is an annual situation, so I'm going to put January through December. They told us we're going to close on the 13th of October, so I'm going to write that in here, not to scale, obviously, October 13th. We know October 13th is when the buyer moves in the house, so the buyer owes the seller for that amount of time plus the day of closing. So then over off to the side, where are my good colors? There we go. Over off to the side, we're going to figure out days owed. So I'm going to say October, November, December. 30 days in December, unless the problem tells me otherwise, 30 days in November. And October is going to be 30 minus 13 plus 1. Or you could count up on your fingers and toes and those sorts of things and figure it out. But remember, if it's the buyers owning the day of closing, you have to add a day. So 30 minus 13 plus 1, 18 days. 18 plus 30 and 30, 18 plus 30 and 30 gives me 78 days owed. Right. Now what? Now we have to get to a rate and we need a daily rate regarding this tax bill. Okay, so let's find how much was this tax bill in Woodfin? 3,000, must be a fancy house in Woodfin. $3,489. Now to get that to a daily rate, I am going to use a 360-day calendar year because we're special in real estate school. And that is going to give me a daily rate. And then once I get my daily rate, I'm going to multiply it by the days owed. And we already learned that the buyer owes the seller 78 days. So let's get our daily rate. $3,489 divided by 360. The daily rate, just leave it in your calculator. I'll draw it out here, but just leave that in your calculator. It should be like $9.6916. 6916. Okay. It should be $9 and essentially 69 cents. But if you ever have to clear your calculator, you want to keep a good 4 digits off to the side. All right, so we're going to take that number and multiply by 78. Very good. And what did we get? We got this number. We'll round up to the penny. What do we do with that number? Well, we are going to debit the buyer $7.55 and 95 cents, and we're going to slide it over to the seller $7.55 and 95 cents. There you go. So the numbers will be the same. Nice. Okay. I'm going to clear the board and we'll go on to the next one. I hope you're feeling okay. Are you feeling calm? Are you able to go at your own pace? That's the beauty of working problems like this. You can kind of just work it out on your own. Okay. Well, that's being wonky. I don't know why, but let's keep rolling. Number 5. And here we go. Again, let's find the root of what we're being asked. I don't like that color. Here we go. So we're looking for who, what, when, where, how. Oh, here's the what, and here's the question mark. So here's our question. What is the total annual tax bill for this property? Aha. All right, so we have an annual tax bill problem. Let's set ourselves up for success and write out the formula. The formula for an annual tax bill is tax assessed value divided by 100 multiplied by the tax rate. Now, if you live in the city, you have to pay city and county taxes. And that equals your bill. All right, let's go back up into the body of the question and get the numbers that we need. Here we go. A house located inside city limits has a current market value of $375,000. The assessed value from the last countywide tax valuation is $336,000. The tax rate for the county is 59 cents per $100 of value. That's why we do 100 over here. And 37 cents per $100 of value for the city. What is the total tax bill for this property? All righty. So as you can see, we have a couple distractors here. So we need to go up in the body of this problem and pull out the assessed value number. Is it this one? No, it's not. Is it this one? Yes, it is. So 336 divided by 100, because you're being taxed so much change essentially per $100 of value, multiplied by the tax rate. Well, this person lives in the city and the county. So we've got 59 cents plus 37 cents. You think I'm kidding? I'm going to add that on my little calculator just in case. 0.59 plus 0.37, 0.96 per 100 of value. All right, and that's going to get us our bill. Okay, here we go. 336,000 divided by 100 multiplied by 0.96. Okay, this property annually will pay about this much money in property taxes. Way better than what I've heard about happening in our northern cities. I had a student from Long Island who said she was paying like $28,000 a year in property taxes. I nearly fainted in the middle of class. That's just unsavory, isn't it? All right, team, let's go ahead and clear the board. And get ready to knock out number 6. We have 8 of these total that we're going to work on. Okay, here we go. Let me find the color that I like. Let's find the question. Who, what, when, where, whatever, you know how it goes. Okay, so it's hidden a little bit here. How? How would the prorated rent appear on the closing disclosure? Ruh-roh, Houston. Hey, Kel, you didn't go over rents with us. I know. I'm going to do it now. So lucky you that you're here visiting with me. Let's talk about how to prorate rent. So people get confused for some reason about rent prorations. So I want you to think of it as if we have a rental house. Let's draw it. Rental house. And we have the owner who is an investor, right? The owner is an investor because they have an investment property. They own a rental home. It's an investment property. Hopefully they're making money on that, or it's helping them with their taxes. Okay, so the owner is the investor. The owner investor is going to sell to a buyer investor. So this is investor to investor is what's happening here. The tenant is not dealt with in this problem at all whatsoever, except that the tenant's probably going to pay their rent. But that's it. We're not dealing with the tenant. We're dealing with an owner who's an investor owning this rental property and a buyer who is buying the rental property. That's important. That's an important distinction. Okay, so as with any proration, we've got to calculate days owed and calculate a rate. Then we have to multiply and figure out who's going to get a credit and who's going to get a debit. So let's put that up here. Let's do it here. Debit and credit. Who is going to get the debit and who is going to get the credit? We don't know. Let's find out if the rent has been paid. Okay. So a seller is under contract to sell a residential rental property. The monthly rent, now we're going to need this number, the monthly rent of $1,550 will be prorated at settlement. Settlement is scheduled for October the 13th. We need that. If seller owns the day of settlement, how would the prorated rent appear on the closing disclosure? Now, this question could be better. We are going to assume it's been paid. I'm going to need to fix that. Assume rent has been paid. A proper word problem would tell that to you. So just take note. Let's draw our timeline. This is a monthly proration for rent, and we're dealing with October. So I'm going to put a 1 there and a 30 there, or else I'll mess it up. I'll make it annual. They're going to close on the 13th. Hopefully it's not Friday. Okay. The rent is paid. Let's say the rent was paid on the 1st. Rent paid on the 1st. Done. Tenants did their job. Yay, the rent is paid. So that means this owner investor here, the seller, is holding the whole bag of money. The seller has all the rent, all of it. Do you think this buyer investor has a right to some of this money? If your answer is yes, you're absolutely 1,000% correct. When and how much? Well, the new owner investor takes possession here on the 13th through the 30th. The seller has a right to keep some of the money for the time the seller owned the property, but now the buyer is going to own the property and has a right to a part of that rent in case something happens to the property or whatever, because now they are the owner. So the new buyer investor wants to be paid for this amount of time. So in this situation, the seller owes the buyer for the time the new buyer investor is taking possession or taking ownership of the home. So the seller owes the buyer. So we're going to debit the seller and we're going to credit the buyer. How much money? Let's find out. How do we do it? Well, you take your rent and you divide by the number of days in the month. That's going to get you a daily rate. And then you multiply by the days owed. The seller owes the new buyer. All right, let's do it. So 1,550 divided by 30, because it's how many days are in the month, equals, I got, ooh, it's a sign of the devil. I got 51 point, yikes, 666. Let's add one more, 6. Okay. How many days are owed? We don't know. We didn't figure it out yet. Oh my gosh. Let's go back and figure it out. Okay. So how do you figure that out? It's going to be 30 minus 13. The seller owes the day of closing, so we're not going to add 1. So 30 minus 13, 17 days. Let's put that here. Okay. Now see, I cleared my calculator, which is a bummer. So now I've got to type it all back in, which is why I need those 4 digits off to the right. So I'm going to plug in 51.6666 multiplied by 17 equals, okay, 878 and 33 cents. So we are going to debit the seller, that's the current owner investor who's selling the property to another investor, and we're going to credit the buyer the same amount of money. I hope that was helpful. All right. Let's scooch along. All right, let's go ahead and dive into number 7. Let me bring my screen back up for you. Excellent. And let me grab my magic markers. Let's go ahead and follow suit and find the question and then dive into the actual word problem. So there's our question, starting with what? What is the minimum price needed for the seller to achieve her goals? What does that mean? It probably means that she needs to net a certain amount of money to achieve her goals. I'm willing to bet you that this is going to be a net to seller problem, but let's find out if I'm right. Let's read it and see. The seller of a property must receive $75,000 profit from the sale of his home. Maybe that should say his. I don't know. I think it should say her. Her current mortgage balance to be paid off is $125,000. The brokerage fee is 7%, and there will be a $1,500. There will be $1,500 in miscellaneous closing costs for the seller. What is the minimum price needed for the seller to achieve her goals? Righto. Okay, it is a net to seller problem. Yay for us. So let's go ahead and draw our net to seller memory circle. Get ourselves set up for success. All right, what do we know? We know that a net to seller is a 3-2-1 problem. We've got your seller's 3D added up. That's their debt, dreams, and desires. So we want to total those. And it's a two-digit rate. And we're looking for one sale price or one list price for the home. Yikes. This thing has a mind of its own today. So this is what we're solving for. What will the price be? We know we're going to have a 2-digit rate. Let me fix that because that doesn't look very clear. Thank you for your patience. Okay, and this will be where we're going to add up the seller's 3D. Let's hit it. Now, I will tell you it's this area here that will give you the most problems. Seriously. So you really want to lock it down that when you have a net to seller problem, it's a 2-digit rate. And I'll show you how that's going to work in just a second. So let's go into the body of the question. The seller the seller of property must receive $75,000 of profit. Okay, that's part of her dreams. Or desires. She either dreams or desires that she's going to walk away with $75,000 in profit. Her current mortgage to be paid off or satisfied is $125,000. We've got this brokerage fee. We're going to need that. And she's got $1,500 in miscellaneous closing costs. Let's deal with the 7% first of all. You will be, unless you set yourself up for success right here, you will be tempted to use 7%. But in a net to seller problem, we use the inverse of 7%. And the inverse of 7% is, or the opposite is 93%. You see, if the seller decided to be a for sale by owner and sell the property herself, she would keep 100% of the profit, but she's going to pay us 7%. So she's only going to keep 93% of the profit. All right, let's go up here to the 3D. Let's line it up. So we've got $125,000 in a mortgage to satisfy. We've got $75,000 that she would like to net, and we've got $1,500 in miscellaneous expenses, closing costs. So let's add all that up. 125,000 plus 75, 123, plus 1500 equals 201,500. Okay. Now what do we do? Well, we're going to take that number that's in your calculator, because we always plug in the upper number first, the top number first. We're going to click divide, click 93% key. Another sign of the devil. Who came up with this practice math situation? Yikes. So we need to put our house on the market for a minimum of this number right here. A minimum. And that's how you do it. Net to seller. I'm going to clear the board and let's go on to our final question, number 8. Let's get the board ready. Whoop, that didn't do it. Okay, I guess we're going down here. All right. This is our final practice problem. Again, let's find the question and then we'll dive in and find the numbers that we need. Who, what, when, where, and how. Oh, here's a how. How much money will the buyer's agent make? Ooh, this sounds like a commission problem. Agents and firms are paid a certain percent of the contract price or appraised value, whichever one is less. And the memory circle for that looks like this. This is the commission. So this is your commission rate or your broker's fee. Do we have a standard fee? No, we don't. Because if we did, that would be in violation of the Sherman antitrust laws. All right, this is the sale price of the home or the appraised value, whichever is less. And this is where commissions earned will live. How much money do you get to take to the bank? The terminology you'll hear when you interview with firms is GCI, and that stands for gross commission income. All right, now that we've done that, let me go ahead and make another circle over here and we'll see if we can solve this problem. Let's grab some numbers that we might need. Hello, maybe I need to clean my little whiteboard. It's acting up, y'all. Let's take the city girls, stick the city girls on them. If you got that joke, let me know. All right, here we go. A buyer's agent will keep 70% of her firm's earned commission split. So let's put this person on this side. Let's make it green. So the buyer's agent is going to earn 70%. So she's on a 70-30 split. Remember us talking about that day one of class? Okay. The sales price of the property is $545,000. We're going to need that number. If the listing firm is offering a 50-50 split of the 5.5% total commission to the selling firm, how much money will the buyer's agent make? Whew, that was kind of convoluted. That got me twisted up for a second there. All right, so if you get twisted up and you like start deer in headlights, just start somewhere. Right, so what do we know? We know that the sale price is going to live down here. So let's just start with the sale price down here. 545. We know we need that number. In this area, we need some kind of a commission rate. Now, the seller agrees in a listing agreement to pay a commission to the listing firm, and then the listing firm gets permission from the seller to share that with someone who brings a buyer to the transaction, often called the selling firm. The selling firm is on a buyer's kind of side of things. Could be a buyer customer, could be a buyer client, could be dual agency, all of that. But first over here, we need an overall commission that the seller is paying. And it tells us that the seller is paying 5.5%, and they're going to share it. The listing firm is offering a 50-50 split of the 5.5 commission to the selling firm, to this person's firm. So you got your buyer's agent, but you also have the buyer's firm. All right, so we've got to divide that by 2 to figure out what everyone's going to get. I just don't like those numbers at all. Who came up with this math problem? 5.5 divided by 2, jeez, is 2.75. That's the rate we're going to use right there. First, the firm for which the buyer works will get paid, and then that firm is going to pay the buyer's agent, the actual buyer's agent. But first, we're going to find out how much will the buyer's agent firm make. So this would be the selling firm. The selling firm's commission. You take your $545,000, and you multiply by 2.75% key. Oh, not too shabby. So this firm is going to get paid in total $14,987.50. Now that's going to the firm itself. Then the firm is going to pay its buyer's agent. How much? 70%. So the firm's going to keep 30%, and the buyer's agent gets to keep 70%. That is just lovely. So what do? You keep that number right there, $14,987.50, and you multiply that by 70%. All right, so times 70% key. And this buyer's agent is going to make $10,491.21. $10,491.25. Okay. I hope that was helpful to run that through. That one was convoluted. Jeez Louise. Okay. Well, I hope to do another math review for y'all. This covered some of your basics, but there are other math problems out there as well. I want to say there are about really, gosh, probably 20 or so different math concepts that you want to have under your belt. Definitely work on anything related to finance. I highly suggest you studying that, your LTV, your monthly principal and interest, those types of problems. And I will endeavor to make you another math review based on some of those types of problems again. Enjoy your day, and we'll see you next time on Kelly's Take Two Zoom review. Hey, remember to subscribe so you get all the latest updates.